Should I move from Raiz to Betashares Direct? We got a question in from Anonymous. I have 8K in Raiz Invest, which is the Emerald portfolio, which has been growing for 5 years in my personal name. Currently investing $30 per week. Its purpose is to help fund a home upgrade in 5 years. I'm keen to start pumping $50 per week once our youngest goes to kindy and we lose the cost of daycare. Since starting the Raiz account, I've learned more about investing and would love to have more flexibility and purchase specific ETFs, something Raiz doesn't let you do. And I think it is now the power of yet. Yet. You can't invest yet. It's not your time yet. Will Raiz do ETFs? Not yet. The fees are also a bit steep. Recently went up to $5.50 a month. Am I better off to sell out of Raiz and move to something like Betashares Direct with DHHF? My name's Glen James. This podcast is brought to you by the Quick Start Guide to Investing. It is the investing book if you want to go from zero to investing and build the wealth you want. I wrote this book with Nick Bradley, the former host of This Is Investing. He's got a YouTube now. We'll put details below, but buy our book, get encouraged with your investing, and it will really help you out. So it can be purchased wherever good or probably bad books are sold. Right, let's just unpack a couple of things here. 5 years investing, sweet. So you're getting to learn about markets and whatnot. I think Raiz is good for any kind of micro investing platform. When you're just getting started, is good because it allows you to get to know yourself. It allows you to set up automatic payments each month into the platform. You can see market cycles, all that stuff. I think Raiz are doing ETFs and direct stuff soon. I've just got a couple of comments here. You're talking about moving to effectively DHHF from Emerald. And before we do that, we'll actually have a look. I've shared on the screen here if you're watching it on YouTube, and I'll just explain it if you're driving and not watching. So the Emerald portfolio has a 10 to 15 year suggested minimum hold time. That's savage. But we know that in another 5 years, this person would have held it for 10, so that's all G in the H. It's considered medium to high risk. It invests in 38% Australian large caps, and that's just with the Russell Investments Australian Responsible Investment ETF. And you can see here that it's just the RARI is the ticker. So 40% there. Global large cap, Betashares Global Sustainable Leaders ETF, ETHI, 34%. It invests 20% in Australian bonds, 21 and a bit percent, and 6% in cash. So I think we'll call this, for the purpose of what I want to talk about today, a 70-30 portfolio. It's just over 25% defensive, which is crazy that that's a 15-year up to 10 to 15 years hold time suggested minimum for this type of asset allocation. But before I get to having a look at the fees, I want the person who wrote in to understand, first and foremost, we're not just changing platforms, keeping the same asset allocation. What you're looking to do is move out of a 70% growth portfolio to a 100% growth portfolio. Now, where I come from, I generally don't like to invest in growth assets if I'm not willing to hold them at least 5 to 7 years. Now, sometimes with investing and goals like this, you can say, well, I'm going to go 100% growth, and if in 5 years' time the market shat its pants, it's not as if we have to upgrade the home that minute. We can push out the goal or whatnot, okay? But also the $5.50 a month, I think the difference with Raiz is that monthly fee comes out of your bank account. It doesn't come off platform. So you'd probably notice it a bit more and be like, oh, I'm paying $5.50 a month. Fees aren't bad. We're paying for a service. It's a fee for service. And don't discount I think Raiz has some cool stuff like the roundups, which is a good feature that could be worth the price of admission of $5.50. If you're rounding up and automatically saving, that would outweigh any type of fee saving if you move to another provider who didn't have that feature. They've got the Raiz rewards, all that stuff. I'm not anti-Raiz. I just think we need to have a look at everything in isolation, but as well combined, then we can have a look at fees. So let's just have a look at the fees of the current $8,000 because the $5.50 a month isn't the only fee. So how we calculate fees, we've got a monthly fee, $5.50, and we have to annualize that, which is $66 per year. The account fee on Raiz, it's 0.275 if you've got over $26,000 or if you invest in their Sapphire or property portfolio. So in this instance, it's zero. The investment fee for Emerald is 0.434%. So we have to annualize all the fees. So I've done that here. So we've got $66, which is the 5.5 times 12, and we've got $34, which is the $8,000 basically timed by the MER or the investment fee. Now, this fee you won't see come out of the account. It's taken off before the return. So if you see a 9% return, the real return would be 9.434%. So the returns are given after fees. So that's $100 a year, which, sure, that's okay, $100 a year. But when we look at the percentage and we go, well, what is that fee there, $100, divided by our $8,000, that's when we get to 1.26% as an annual fee. I probably think that's getting up there if I'm being perfectly honest. I'm probably looking at getting it out maybe based on that fee. Now, another thing, and for the future comparisons, I'm not going to get into the weeds of this buy-sell transaction cost, but in the Raiz PDS, there is a 0.16 spread. So when you transact in and out of the portfolio, it's going to be another $4 a year based on, and I've just used the $50 per week. Okay, so, but I'm not burying the lead. The lead is the total fee at the moment of $8,000 is 1.26%. So like everything, we want to get our strategy right first, then we look at investing. If you've rocked up today telling me that the strategy is 5 years, I think we need to keep to potentially a 70-30 portfolio, not jump up to DHHF or an equivalent growth. You've also told me now that because you've learned more about investing, you haven't said here that because you're in we'll call it a ethical of sorts portfolio at the moment. Emerald, you're now telling me that you're okay to just go to the market and get DHHF. So there's a change in strategy here. There's a change in asset allocation and there's a change in the actual investment. So what I've done is I've looked at the Betashares Direct portfolio here, and you'll see the fees. And this was when Betashares came out. They're like, there's no transaction fees to buy ASX stuff. I was like, sweet. So they make their money using the custom portfolios, and it could be a minimum of $3 per month because you could literally, and I haven't done this because I just don't know how helpful it is, and you could do this yourself, but you could literally look at these ETFs, which is on the Emerald portfolio, the Russell Investments, RARI. You could look at ETHI. You could look at IAF. You could look at AAA, the high interest, like the 4 underlying investments in Raiz. You could put that onto the Betashares platform. I just haven't you could build that, but I think it's a bigger question about what you want to invest in. So because the monthly fee and the account fee on Betashares is 0 because you don't have a custom portfolio, you're just rocking up, buying an ETF. There's no brokerage. If you did buy a Vanguard VDGR on Betashares Direct, you can see here that the MER is 0.27 with Vanguard, where on the Emerald portfolio, it was 0.434. So the actual portfolio is a little bit cheaper. And this is where you will always pay for a higher amount, potentially in fees, when we start to get to ethical and screening portfolio. So again, not a like for like in terms of the exact investment, but I'm just doing a like for like in terms of asset allocation because you didn't tell me that you wanted another ethical investment. So we're basically looking at $22 a year or 0.27 for Betashares Direct per year. So all day long, would you rather pay 1.2% or would you rather pay 0.27%? I know what I'm going to pay. However, that's not everything. Let's continue on and have a look at if we did invest in DHHF on the Betashares Direct platform, you're looking at 0.19% or $15 a year as opposed to the 0.27. Now, in my world, where I'm from, 0.27 or $21 versus $15, I'm saying that's basically the same price because it's not going to make or break your net worth. Okay, fees matter, but when you zoom out and see what's happening, basically the same price. Now, the other issues that I potentially have is I want you, if it is a 5 years, I haven't looked at returns here. You can log in and see what the historical returns have been, just to give you an idea. The Emerald did a little bit better than VDGR, and the VDGR ETF is the Vanguard Diversified Growth portfolio. The Vanguard Diversified High Growth, VDHG, that one there is the more popular one, which is a 90% growth, 10% defensive. I'm generally not one of those guys that are out there in Moneyland going investing 100% equities. I just think we need a balanced portfolio. We need some defensive portion because a lot of people out there online making content in the last few years haven't been through a GFC. They haven't been through and invested into a big event. So we want some stability. We want some comfort in our portfolios. And if someone's saying they've got 5 years, well, I don't think it's 100%. The VDGR, Vanguard Diversified Growth portfolio, minimum suggested hold time is 5 years. So there's some comfort there. But there's a couple of things that this portfolio, either of them, the Emerald or the VDGR, VDHG, I don't know about VDHG, just lost my train of thought, but the VDGR and the DHHF and the Emerald portfolio, I mean, yeah, some of these, yeah, it's probably right for VDGR, but in terms of diversification, you've got no real estate with these portfolios. You've got no infrastructure. You've got no Aussie small caps. You've got no global bonds. I don't believe so. Yep. So you've got no gold, okay, if that's important. And I think there is an argument for a little bit of gold in a portfolio. So we look at the Emerald portfolio, relatively high fees and not that much diversification. We look at VDGR, relatively good-ish fees, limited diversification. We look at DHHF, low fees, limited diversification. I think this person needs to probably do one of two things if it is a hard 5 years. And they are learning about investing, which is cool. There could be an argument to just pump the mortgage with extra repayments for 5 years. Then it's like, yeah, guarantee 5.5% return, done. Like, that's also okay if you don't want to do this. The other thing that I want this investor to consider, I want you to consider potentially robo-investing platforms like LifeSherpa Invest, StockSpot, the team at Rask have a portfolio, because you're going to get more diversification, probably a better and smoother return, and still pay around 1%. But I think diversification is important. I personally use the LifeSherpa Invest, and for the reasons, I'm happy to pay around 1% and get some extra diversification, because I want access to infrastructure. I want access to Aussie micro caps. I want a bit of gold in my portfolio. And yeah, so I think if we're looking at fees, I want cheaper. This is killing me, $5 a month coming out of my bank account. Yeah, it's going to be cheaper with Betashares Direct. It'll probably be cheaper with Betashares Direct to build the current portfolio that you've got on Betashares. Pay the 0.26, I think it is, their custom portfolio fee. Pay a bit extra over there, because the account fee at Raiz is also 0.27. Set it up for auto rebalance. You could basically copy their portfolio on Betashares Direct. You'd probably have a hard time copying LifeSherpa, StockSpot, or Rask because they use unlisted assets. I know LifeSherpa Invest does because I use that, but I don't know. There's just more questions that I've got in relation to this strategy. But good on this person for sticking with it for 5 years, right? Good on this person for really almost understanding investment more. And they may want to take that extra risk and go, yeah, I'm actually happy for 100% growth for the next 5 years. I'm personally not doing that. My portfolio with LifeSherpa Invest is the, I think it's the Everest portfolio, and it's still not 100% growth. I'm just not a 100% growth guy in a portfolio. But yeah, I would encourage them to check out one of the robo-investor platforms. You'll just get more diversification and probably a stronger return. But that's my comments in relation to Raiz versus Betashares Direct. Now, I will say, if you use the Raiz Rewards program regularly and you use the Roundup feature regularly, sure, I'll pay a little bit more fees because I want those features. It's all good. If you rocked up and said, yeah, I'm doubling down on Raiz, well, the transparency's there. You can see the ETFs they invest in. There is no problem with Raiz, but if you just were like, yeah, I just want cheaper fees, I don't use any of the features, there is cheaper fees elsewhere. But that's just objectively true based on this portfolio. Thanks so much for listening today. Let me know below, what are your thoughts on Raiz, Betashares Direct, robo-advice, and please feel free to forward this to a friend or family member. Correct me in the comments. I always get corrected. Happy to be corrected. And I'll see you soon. Bye.
Any advice is general financial advice only, which does not take into account your objectives, financial situation, or needs. Because of that, you should consider if the advice is appropriate to you and your needs before acting on the information. If you do choose to buy a financial product, read the Product Disclosure Statement, PDS, and Target Market Determination, TMD, and obtain appropriate financial advice tailored to your needs. Simo Interactive Pty Ltd, the publisher of this podcast, and Glen James are authorised representatives of Money Sherpa Pty Ltd, which holds financial services license 451289. Opinions or comments from any guests on the podcast are theirs and not those of the host or the publisher or their respective license holders.